So, if there's one theme that has defined really what we've been seeing in the broader economy over the past few months, I think it would have to be the unraveling impacts of the interest rate hikes that we've seen from central banks throughout 2022. And what it's really done is it's exposed various weaknesses in our financial system and in certain banking business models. Where we've seen some regional banks out of the US have some serious problems stopping depositors from fleeing due to the massive losses that banks have been forced to take on their fixed income portfolios as a result of these rate hikes. But another effect that is becoming more and more prevalent is the higher mortgage payments that have come also as a result of those rate hikes, and particular for Canada, which is going to be the focus of this video, as Canada is a country that has a unusually high amount of household debt, and this is starting to raise some real concerns. So what I'm looking at here is the 2023 financial system review that was released by the government a few weeks ago. And right off the bat, what it does is it highlights the increasing debt service costs faced by Canadians. Now, I talked about debt service costs in a previous video on this channel, but to summarize, Canadians do have a abnormally high amount of household debt. So what we're looking at here is the total household debt as a percentage of net disposable income for 2022, which is the latest data. And we can see the ratio for Canada here is about 187 compared to similar countries like the US, which is 101%, United Kingdom at 148%. So this is raising some concerns specifically for Canada. And what you can think of the debt service ratio as mainly is what percentage of people's disposable income has to go towards debt service, mainly on things like mortgage payments and really just all types of debt service. And obviously, this can be problematic because as debt service becomes very expensive from these rate hikes, this can suck consumer spending right out of the economy and potentially cause a recession because it's forcing consumer spending towards debt service and away from other areas of the economy. And if incomes don't rise in conjunction with that debt service, then you're going to have sectors of the economy, particularly discretionary sectors, really start to suffer. So, the one key risk that this report mentions is that as more and more Canadians get forced into higher interest rates on their mortgage, and if you combine this with potentially a recession that reduces employment in the overall economy, this could lead to defaults, specifically on uninsured mortgages with negative equity. Because normally, if a homeowner defaults on their mortgage, the bank always has the home as collateral that they can use to cover the outstanding balance of that loan. But if the mortgage balance is higher than the value of the actual home, which is a possibility now because we have seen home prices actually decline quite a bit since last year. Now the bank has credit losses, and whenever banks have sudden unexpected credit losses, the ripple effects of that are usually pretty disastrous for the overall economy because banks, when they start to have a lot of losses, they become much more conservative. They become less willing to provide liquidity to financial markets. And when you combine mass forced selling of assets with lowered liquidity in financial markets, then asset prices in general can fall quite a bit. But the key question right now is how likely is that to actually happen? And I'm going to talk about this later in the video, but I first want to point out some key data points that was mentioned in this report that I think are pretty interesting and really just save you the time from reading this yourself and give you the key information. Now, the first data point I want to look at here is the shift from demand to term deposits. Now, this is pretty important for banks in particular because it really impacts their cost of funding because demand deposits for banks are much cheaper than term deposits. Demand deposits would just be things like a basic checking account, whereas a term deposit could be something with a GIC, so something that has a higher rate attached to it. And clearly from the data here, we can see as soon as those rate hikes started commencing, the demand for term deposits started increasing quite a bit. And this is not exactly unexpected. It's really the whole point behind these rate hikes by the Bank of Canada. It's inducing people to save money to earn those higher rates as opposing to spending it. So that's one interesting thing. The other one is they start talking about commercial real estate, and they actually give data here on real estate investment trusts in certain commercial sectors. So the green is industrial, which is actually increased dating back to around 2020. The retail subsector, which is the blue in here, has remained pretty much flat, whereas the office subsector has predictably gone down quite a bit. And this is something that we've been kind of expecting, as we see the shift to more remote work happen in the economy, there's a lot of office vacancies, and it makes it more difficult to obtain tenants, which means any long-term debt that is attached to these buildings is going to be much harder to finance if you can't find tenants. And we actually saw something like this happen, I think, a few weeks ago when Brookfield ended up defaulting on one of their loans on their commercial properties. So it is a valid concern, but they're basically stating here that banks overall don't have massive exposure to this subsector. But one thing I did want to state is certain banks, like Western Bank, Canadian Western Bank, and Laurentian Bank, these banks do have abnormally high exposure to commercial real estate. So if you are invested in either of those companies, I'd recommend looking into that. I'm personally not invested in those companies, so I don't know too much, but I do know that that is a unique feature of those companies in particular. But let's now switch to the household section here, because this is where they start to point at some very interesting data points, and they actually give us some details on the DSR, or the debt service ratio. So what they state here is that the median debt service ratio on mortgages rose from 16%, so that's 16% of disposable income, remember, to 19% over 2022. So 300 basis point increase. It's sizable, but it's not, drastic. What is more drastic is the share of new mortgages with a debt service ratio more than 25%, which increased from 12% to 29% during the same period. That is a much larger jump, and that does kind of strike you a little bit. And the key risk associated with higher debt service ratios is basically what they state here, which is higher debt service ratios reduce the flexibility for borrowers who experience an unforeseen increase in expenses or losses in income. So that could come from something like losing your job, which we would obviously see through any changes to the unemployment rate. Now, they also gave this chart here, which is another pretty interesting one. And they basically compare the percentage increase in home prices in certain time periods. So you have February 2022 in blue versus April 2023 in the yellow. And it's basically the change from February 2020, because we all know home prices, they increased quite a lot during, those lockdown years. But then it shows, the relative pullback that we've seen as a result of higher interest rates throughout 2022. And they make the point here that there are some homeowners that have negative equity in their homes, and if they cannot afford the payments anymore due to a loss of income, i.e., unemployment, then they may not be able to refinance their mortgage and they may be forced into a default. And then if we scroll down here, they also point to mortgages that are in arrears, which they define as basically 90 plus days delinquent. So the homeowner hasn't made a payment on their mortgage for at least 90 days. And they show the historical correlation between this and so the mortgages in arrears versus unemployment. And we can see it pretty much moves in lockstep, right? With really the blue being the unemployment, kind of being a leading indicator for the share of mortgages in arrears. So to me, it seems like the unemployment rate is really the key trigger here. Obviously, there's this one part here where it detaches quite a bit from this correlation, and this was kind of bridged by the government providing emergency funds during those periods. But it's a pretty interesting relationship, and I'm really glad that they included this data here because it really does tell us quite a bit, and it really helps educate Canadians on just the intricacies of the economy and why the unemployment rate is so important in the first place, and why it's especially important now as well. And if we scroll down a bit more, another interesting statistic they point out relates to credit card debt, and specifically credit card debt for homeowners that purchased a home in the period 2020 to 2022 versus 2017 to 2019. And they stated that those that purchased a home more recently, on average, are carrying 17% more credit card debt than those who purchased earlier. And this is actual credit card debt. This is not just a balance on a credit card. This is where they actually have an outstanding payment due. And this is pretty interesting because it shows us that those who were most negatively impacted by the rising rates have chosen to tap into their credit cards for their just regular spending. So we can assume that they've probably exhausted all of their savings and have now resorted to credit cards. And this is pretty concerning, I think. This is overall something that you do not want to see. But we have to keep in mind the context, and we're talking about a very small minority of the population that's actually impacted here, being just people that purchased a home from 2020 to 2021, or 2020 until the beginning of 2022, which is potentially the worst situation to be in. So that's another interesting data point. And then if we scroll down here, the last thing I want to point out is this simulation that they actually ran regarding the potential increases that we could see to mortgage payments, and breaking that down by the different types of mortgage payments there are, and what impact will it have overall on the economy. And what they're showing us here is two things. Number one, what is the actual increase to the mortgage payments going to be? And number two, when is that likely to occur? And what they're saying here is that for fixed rate mortgages, the average increase in payments at renewal will be greatest in the years 2025 to 2026 and will be between 20 and 25%. For variable rate mortgages, this is going to change depending on the type. So you have variable rate mortgages with variable payments. So these increase in conjunction with changes to the interest rate, and then variable rate mortgages with fixed payments. So variable rate mortgages with variable payments, these have obviously already happened, right? And what they're saying here is that the borrowers have already experienced an increase in payments close to 50%, with the bulk of the increase taking place in 2022, which is when those rate hikes were actually happening. And then for fixed payments, these borrowers will need to increase their payments by approximately 40% to maintain the original amortization schedule, which is a requirement, assuming renewal in 2025 or 2026. And if we scroll up here, they provide data on basically when these mortgages are actually going to renew. So by the year 2026, then pretty much all of these mortgages are going to be renewed at the higher rates. And at that point, we will have full details on what the impacts were eventually going to be. But really, for me, the key takeaway that I got from all of this is yes, the payments are increasing, but as long as they can still be afforded, then it's really not going to cause anything drastic, right? There isn't going to be any economic meltdown or some massive severe market crash. As long as employment stays okay, then the storm should be weathered. And so that begs the question, what is the employment rate at today? And it's at historic lows, which I think is pretty interesting, right? And if we look here, this is the 10-year chart for the unemployment rate in Canada. We can see it was kind of on a downward trend from 2016 to 2020. Obviously, something happened around this time period that caused it to go up, but it's really, gotten even lower to when it was at that point. We can go back even further, 25 years. It's extremely low historically. So this kind of points to the fact that Canadians may be able to be resilient and may be able to get through and manage these higher mortgage payments, even though it does pose a real risk. That risk may not actually end up getting exposed. Another key data point that we can look at that's kind of related to all of this is retail sales. Now, this is another general economic indicator that gets reported every month. And if we start seeing this go down more and more, this may actually be a leading indicator that can flow through into the unemployment rate. And you would think with Canadians allocating more of their budgets to debt service as opposed to retail spending, you would see this have a sizable decline. But we haven't really been seeing that happen just yet. And we can look at the chart here where it was a negative 1.4% decline month over month most recently. And if we look at retail sales on a year over year basis, we can see it actually increased year over year in the most recent time it was reported. So this is still early, right? Because as we just saw previously, the full effects of these higher mortgage payments are going to be gradual from now pretty much until 2026. But one explanation that I would like to offer could be how Canadians had record savings during the lockdown years. So if we look here, this is the savings rate, the household savings rate in Canada. And to really understand the context, we have to look at this going back 25 years. So this is the percentage of disposable income of Canadians that they save as opposed to spend. And we can see during, the lockdown years, it increased significantly from its historical average, which was, between 0 and 5%, going back 25 years. And it increased significantly and it kind of stayed high, right? It even, came back up a bit around this time period here. It didn't just, increase and then immediately go back to its historical average. So to me, what this tells us is that the level of savings that normally would have taken Canadians 2 to 4 years to accumulate only took about 1 year in that time period, and it happened for more than 1 year, right? And obviously, you combine that with the government subsidies that were given out during that time period, and this can provide somewhat of a buffer and allow Canadians a grace period where they eat into some of their previous savings to meet their spending in conjunction with the higher debt service costs, and they don't really have to adjust their spending on retail items just yet. But obviously, this is only temporary, right? If debt service costs remain high well into the future and incomes don't increase to offset that, then you're going to have to see less spending in other areas of the economy, which reduces economic growth and probably leads to more unemployment. And as we discussed before, that's kind of the trigger to this whole thing is the unemployment rate. So I think that is definitely a very important data point to keep an eye on, and obviously also keep an eye on retail sales because this can be indicative of whether Canadians are actually being forced to allocate spending away from retail items and into the debt service, which could flow through to the unemployment rate and be an indicator of that. Now, one last thing I want to touch on is something that we've seen a lot of talk about lately in the media, and that is this so-called extending of amortization periods for mortgages. And I think the way that this has been phrased in the general media lately has been a little misleading because these extensions are not something that's permanent. It's not like this is some cheat of the system that's happening. Once the mortgage comes up for renewal, which is usually every 5 years, and as we saw previously, by the year 2026, all mortgages would have been renewed, it has to revert back to the original amortization schedule. And despite all this, the good news for homeowners is that home prices are actually going up. So this is the CREA website here, and they have their home price index, and they state here it actually climbed 1.6% month over month, but was still down about 12.3% on a year-over-year basis. But home prices are starting to creep up. So this so-called housing market crash that was going to take place as a result of these higher interest rates, this is what that market crash actually looks like. This is going back to the year 2005, and home prices are actually still higher today than they were even at this beginning of 2021, which is around here. The average home price is still, quite a bit higher than over $100,000 higher than it was at that point. So the fact that we saw existing home sales increase that much and the average price of a home in Canada increase month over month, we obviously why this is happening now in April, right? Because the Bank of Canada, they offered a lot more clarity on their future interest rate plans. They stated no more increases were going to be coming unless we start seeing that CPI number increase again. So to me, what this data tells us is the higher interest rates aren't really a problem for Canadians. They were really just waiting until they felt comfortable knowing rates wouldn't go any higher before jumping back into the housing market. And this does also, I think, give us some answers on whether or not higher debt servicing costs will be tolerated by Canadians because all these new home sales that are happening are supposedly going to be at these higher interest rates, right? So if Canadians couldn't handle these higher interest rates and they felt they were too high and they would truly be reducing the demand for, housing and the demand for mortgages, then there's just no way that this housing data would be what it is. We wouldn't be seeing housing prices go up. We wouldn't see such a substantial month over month change in home sales. So to me, those two data points are pretty telling. But anyways, guys, that pretty much does it for this video. So thank you so much for sticking around and listening. I hope you did find this video useful. If you did, then leave a like. And if you're new to my channel, I'd appreciate if you would consider subscribing. And I'll see you guys in the next video.